you to this morning, and I wanted to welcome you to this morning's presentation on a market update during Israel at war. As a quick introduction to myself, as many of you will know, sorry, we seem to have a problem here with the slides. If you can hang on just for one moment. Good. Sorry for that bug in the system. So as I know, some of you already know me, but my name is Andrew Album, and I'm a senior wealth manager here at Pioneer in Israel with our offices in Herzliya. Pioneer is regulated by the Israeli Securities Authority, and we're a provider of investment and financial planning advice here in Israel. Separately, just in terms of my own experience as a financial advisor, I'm also a senior partner at St. James's Place in the UK. I have over 3 decades of experience in investment advice and wealth management, and that makes me currently the only financial planner in the world who is licensed in both Israel and the UK and works for leading financial organizations, wealth management organizations in both countries. Very important to just stress, of course, the two businesses are entirely separate. What I bring, though, is a marriage of experience and knowledge of both of these markets and of other international markets as well, being a qualified chartered accountant and a member of the Australian Institute of Chartered Accountants. Let's start with a quick look at where we're up to so far this year, because of course, here in Israel, and I will touch on it shortly, it's been a very, very challenging year from beginning to where we are today. But for global investors, the picture has actually been quite different. So far this year, global stock markets have responded very strongly and recovered very well from the sell-off of 2022. And you can see that the benchmark US S&P 500 index is up almost 20% so far this year. Some global markets have lagged that, specifically Tel Aviv and China, both in the negative for the current year. And it has also been a challenging year for bonds. If you remember, the sell-off last year was not just for stock markets, it was for bond markets as well as interest rates rose. This year, interest rates have continued to creep up a little bit, which means that the returns for investors from bonds haven't quite come through as expected this year, but that's definitely a positive going forward, as I'll explain in a few minutes. One other thing just to quickly point out is the 3-year picture for gold. We've been through a pandemic, we've been through a war in Ukraine, we've been through rising inflation and rising interest rates. And yet through all that turmoil, gold has continued to prove to be a very poor investment. It's something that attracts the interest of the media every once in a while, that perhaps now's the time to buy gold, but consistently gold investors have been disappointed in this asset class. In terms of where we are and what's been the key drivers, I think the most important factor driving global markets this year has been that the world hasn't tipped into a recession. At the start of 2023, with rising interest rates, there was much talk of a hard landing, as it's called. And in fact, in most countries, it's been what's termed a soft landing by the commentators, which basically means that economic growth has slowed without contracting. And that's been a positive for markets, with economic data having been far better than was anticipated. There's definitely still the possibility of a recession next year, which can't be discounted because economies are slower than they were and interest rates are much higher. But I think the general consensus would be that either next year will be one of moderate growth or a mild recession, if at all. Interest rates certainly seem to have peaked over the summer, which is obviously a good thing. And one of the key drivers behind equity market performance has been the recovery of the technology sector, the big global tech superstars like Google and Apple. And that's been buttressed by a lot of interest in the area of artificial intelligence, AI, with shares like NVIDIA having performed very, very strongly on the back of a huge increase in demand for their products. In Israel, of course, it's been a very, very challenging year with, firstly, the protest about the judicial reform and the slowdown in the tech sector, and then the tragic events of last month and the ongoing war in Gaza. But even in Israel, I think interest rates and inflation seem to be peaking. For investors who live in Israel, for people who've made Aliyah, still remains fundamentally important to never lose sight of the importance of having an alignment between the assets and income that you have and the currency you're spending your money in, and therefore to be wholly dependent on foreign currencies for your wealth and your income creates an unnecessary currency risk. And even though in the short term, the shekel has not been as strong as it has been for many years, the picture is still one of many, many years of considerable shekel strength. So I would suggest to any investor to remain aware of the huge risks of having all your money on foreign currencies and nothing in the Israeli shekel. What should we be thinking about going forward then as investors? Certainly the first thing is that consumer price rises, inflation seems to have peaked. We certainly appear now to be in a position of disinflation, of inflation rates falling. That's something that shouldn't be ignored, because that's also going to have a very fundamental impact not only on investment returns going forward, but perhaps more immediately on interest rates. And you can see in this slide that the benchmark yield on 10-year US Treasuries, which is the US government debt, have been on a very, very sharply rising profile over the last 3 years. US long-term interest rates, 10-year interest rates have gone up from barely above 1% to almost 5% in a very short space of time. For people with money on deposit who've been keenly watching interest rates and taking advantage of these high interest rates that have been available now on deposit accounts, that's been a good thing. But what we've seen in recent weeks already is a very rapid downturn in interest rates as reflected by the bond markets. And that's going to probably feed through in the next year or so as money comes off deposit and the rates available on sterling, dollars, and shekels starts to fall quite rapidly, reflecting the trend that we can see on this slide. The third thing on path after inflation and interest rates to be thinking about as investors is again the classic mistake that a number of investors and their advisors and financial managers make, which is trying to select which stocks are the right ones to invest in, which shares are going to be the best performing shares. Because as we can see from this chart, the best performing shares over the past 9-10 months on the US stock exchange, which is the world's biggest market, are almost entirely ones that most private investors do not have in their portfolios. You know, almost nobody would have predicted that Nvidia and Meta, which owns Facebook and Instagram, will be by far and away the best performing 2 blue chip stocks in the world this year, let alone in the USA. And this approach of stock picking is one that many investors and many financial managers spend a huge amount of time talking about, a huge amount of time thinking about. And it's almost a waste of time, because to select and pick the best stocks is an almost impossible task, which is why we at Pioneer prefer very much to focus on whole markets and whole indices, because then the risk of picking the wrong stocks is entirely avoided. You don't make that mistake of just investing in a number of shares that underperform and missing those that do well. The fourth lesson I'd remind pretty much everybody on this webinar to be thinking about is what I call home market bias. So many investors still think in terms of the currency of the country they made Aliyah from, and the markets, the stock market, the companies of the country that they made Aliyah from. They invest in familiar names and they pay typically an enormous price because they do so. This chart is just one example. It shows the massive underperformance of the London Stock Exchange against the US market. But if you're a Canadian OLE, or if you're an Australian or South African, you're in exactly the same situation. The market that you came from has consistently underperformed global markets, and to have money in that currency, sterling, the Australian dollar, the rand, means you've been in a depreciating currency, and to be overinvested in the stock market of the country made aliyah from London, Sydney, Johannesburg, Toronto, means that you've also lost a huge amount of potential investment performance. Home market bias is one of the biggest risks and the biggest causes of loss of wealth or loss of return for Olim living in Israel. It's something you should be really focused on. So you need to be thinking about the impact of falling inflation on your asset allocation. You need to be thinking about the impact of declining interest rates on money that's on deposit and how that will impact your investment returns going forward. You need to think about the importance of investing in whole markets rather than trying to select individual companies. And you need to be very aware of the risks and the consequences of home market bias. As all of you know, and you really don't need me to remind you of it, the last few years have been ones of considerable turmoil and uncertainty. Outside of Israel, these have primarily been the COVID pandemic and the impact of the Ukraine-Russia war and its consequent effect on inflation and interest rates. For Israeli investors, we've experienced both of these two phenomena, and on top of that have been the terrible and tragic events of 2023. And through periods of turmoil, it's very important to remember how crucial it is to stay focused on our longer term objectives, to stay focused on our strategic strategy, and not to be blown off course by short-term turbulence or events that are going on. And it starts by remembering that financial markets are a breeding ground for poor investment decision-making and poor investment choices, because fear and greed are what drives markets in the short term. And if we're long-term investors, which all my clients are, like myself, then it's very important to try and block out the cacophony of news that's driven by these sentiments of fear and greed, and that too often leads us to make short-sighted and poor investment choices. And poor investment choices compound through time to have a significant impact on our wealth and our financial security. And so making the right investment choices can have a transformational impact on our long-term financial security and our long-term peace of mind. So here are just 5 key takeaways to perhaps be thinking about during this presentation and afterwards in terms of your own wealth. The first of these is the importance of time in the market, not timing the market. The importance of staying patient. Always remaining diversified in our investment approach. How valuable it is to keep the fees that we're paying down. And of course, the necessity to minimize tax legally wherever possible. In terms of time in the market, I think this is a very important slide. It just shows the probability of getting returns above inflation over different periods of time from the world's biggest stock market using data that goes back to 1871. So we've got 152 years of stock market data. And what does it show us? It shows us that if we're investing just for a period of 3 months, the likelihood of us outperforming inflation is just 60% of the time. If we move up to a 1-year time horizon, it's 70% of the time. But for longer term investors, of course, the probability of outperformance is really, really high. Over 5 years, it's over 80% of the time. Over 10 years, almost 90%. And on a 20-year time horizon, it's pretty much 100% of the time you're going to see a real return on your money from investing in shares. And that's why shares for almost every investor are a key part of a diversified investment portfolio. This slide is shown in a different way by the rolling 1-year returns on equities. The blue line shows what you'd get each 1-year period, depending on when you start and when you finish. And you can see it varies hugely. But the orange line shows what the returns are over a rolling 10-year period. And the most important thing I think to bear out from this is it doesn't really matter so much when you start. Almost over every single 10-year time horizon, you're better off investing in equities, and the returns are very, very consistent. Patience has its rewards is the second it is a very much an important theme for investors. And the patience of taking a longer term view I've already shown. But I also want to show just how even this year, in 2023, for global markets, which have been entirely unaffected by both the political and military events in Israel, it's been a very bumpy year, as almost every year is. And it's very easy to forget that at the end of the year and looking back over time, where most of the big events that move markets tend to just disappear and dissipate into long-term trends. So we started this year with a very strong rally on global markets with increasing optimism that interest rates and inflation were going to be peaking. Then we had the financial crisis that affected a number of banks, starting with the collapse of Silicon Valley Bank in the USA, two other of its smaller competitors, and then the folding up of the Swiss financial giant Credit Suisse. Markets gave up almost all their returns in the early spring. Then we saw a period of increased optimism, and gradually markets recovered those losses and made the way to further highs, peaking in the summer before warning some central banks about the sort of stickiness of inflation and the fact that interest rates weren't coming down anytime soon, caused a considerable autumn sell-off where we had 3 successive negative months for investors. And as usual, just as things start to look a bit despairing, sentiment swings rapidly, and you see a marked recovery. And we've seen in November, stock markets post really strong returns. So again, it's very easy to be caught up in that cacophony of news. It's very easy to make emotionally driven tactical decisions, which end up being mistakes. Financial markets are story generating machines. My job as an advisor and your job as an investor is to try and shut your ears off from all that noise and stay focused on your long-term goals. And there you can see very clearly what the long-term reward can be from investing in global markets. This is the S&P 500 over the last 30 odd years. And you can see it's produced huge returns, and almost every single event through that period barely registers as a blip now, with the exception of the dot-com bubble bursting in 2000, the great financial crash of 2008, and the onset of COVID in early 2020. But even those 3 major seismic events that caused considerable sell-offs, still from a long-term perspective, haven't had that much effect. The next lesson I want to focus on, which again is a problem from, in my experience, a number of the investment managers I've seen over the years, but also especially private investors managing their own money, is their desire, their innate desire to feel they need to be doing something. They need to be responding to the latest piece of news, taking action on the basis of something they've just heard or read that seems particularly credible, and the mistakes that can be caused by doing that. There was a very, very interesting study conducted by a number of academics a number of years ago, but it really remains very relevant, about elite goalkeepers in football and the case of penalty kicks. And the research that these 5 experts conducted showed unequivocally that by not diving just before a penalty kick is taken, you have a far higher chance of saving a penalty. Far more penalties can be saved by a goalkeeper standing until the last moment, seeing where the ball is going and diving, because more often than not, penalty kick actually goes into the central third of the goal, where a standing goalkeeper has a very high chance of saving it. In spite of this, most of the world's elite goalkeepers dive just the moment the penalty is taken, either to the left or to the right. And of course, if the ball goes the same way they've dived, they suddenly look very clever. They can often save it. If it goes the wrong way, they can't. And the researchers approached a pool of the world's most successful goalkeepers and asked them the question, given the empirical evidence is so clear that if you wait until the penalty kick is taken before you dive, you've got a much higher chance of saving it, why do you always dive before the kick's taken? And the overwhelming response they got was this: if we don't dive, we look as if we're doing nothing. If we dive and we save it, we look really clever. But if we dive and we don't save the penalty because the ball's gone the other way, at least it looks as if we were taking action. And that's a really sound lesson for all investors to draw upon. Just because you dive, it looks as if you've taken action. Just because you're making a change in your portfolio, it seems like you're managing your portfolio. It's not correct. More often than not, the best decision is no decision at all. The best decision is to stick to your long-term asset allocation, to remain focused on your long-term strategic goals, and not let that cacophony of noise allow you to make poor investment choices. Diversified portfolios always remain the way to go. Which asset class will be the best performing asset class next year is a question often asked of commentators, often raised in newspapers and the financial press towards the end of a year or the beginning of a new year. And everyone has an opinion. Almost always everybody is wrong. But what this chart shows is that this year's best performing asset class more often than not be a poor performing asset class next year and the year after that. And actually the best approach for all investors is a broadly diversified portfolio. Those who want higher growth or a longer time frame or prepared to take higher risk definitely need to have more weighted into growth assets. Investors that are more cautious, investors with a shorter time frame, investors perhaps who want income, perhaps should have a lower risk investment portfolio. But putting all your eggs in one basket is almost always proven to be a huge mistake. Over time, one asset class doesn't outperform. Over time, a diversified portfolio approach provides far better returns with far less volatility, far lower risk. And Nobel Prize studies studies on this subject have won Nobel Prizes for their work that it's really asset allocation that determines the bulk of investment returns. And as we've seen perhaps in the past few slides, trying to time the market or trying to pick individual shares is not a way to generate real growth over time with our wealth. The fourth thing I think every investor needs to focus on and refocus on at a time like this is the question of fees. And answer yourself the question, are you paying too much in fees? I meet many investors who have no idea how much they're actually paying for the investment management that they have, for the funds, the products, the portfolios that they have. I come across clients who are with, for instance, certain Swiss banks. They never ask the question. They don't realize they're paying an annual management fee, plus a fee on the funds that they're utilizing within the portfolio. And when it all adds up, the fees are far higher than they expected. And many people who made Aliyah from the UK, who have investments with firms like Canada Life, well, they have no idea that their total annual costs are often in excess of 2.5% a year. If your investment managers and advisors are taking 2.5% a year, that really doesn't leave very much for you, does it? And I've got many clients who've invested with Pioneer, having cashed out of these kinds of investments, where they found that the total fees they're paying have been reduced perhaps by 50% or even more, which means far more of the return on the portfolio is going to you, the investor, and far less is being taken away by everybody else. Yes, it's important to get value for money. Yes, it's important to have professionals managing your money properly. But paying exorbitant or unnecessary fees is just really a waste of your money and means far more of the returns aren't going to you, they're going elsewhere. Perhaps it's now a very good time to ask your financial advisor, how much am I paying? And working out whether you're actually being charged more than you should be, and therefore rethinking what you're doing. And then the final thing in terms of what should we be thinking about as part of a strategic review is ensuring we're not paying too much tax. There's that old investment adage, don't let the tax tail wag the investment dog, which I'm sure many of you have heard of. It's very, very important to remain focused on taxes. Are we unnecessarily paying income tax on investments? For instance, if we are a new OLE within our 10-year exemption, we've left assets behind in Australia or Canada, USA, America, UK, wherever, we're paying income and capital gains tax that we shouldn't be paying. We wouldn't have to pay if we structured our assets properly. Are we incurring unnecessary holding tax on dividends on foreign shares? Are we not an American, but we've suddenly created for ourselves inadvertently a huge liability to US estate tax? I mean, many people have got US investment funds, who've got US shares, Apple, Google, JP Morgan, whoever, they're living here in Israel. they're not American, they don't even realize it, but they've got a significant US estate tax problem. Or they've got a UK inheritance tax problem, although they've made aliyah from the UK, but they've left their assets incorrectly positioned, their affairs not right, not in order, and they're leaving their beneficiaries ultimately with a large inheritance tax bill that could have otherwise been avoided with some careful planning. So some food for thought at this time. Of course, there are more important things to be thinking about here in Israel today. Far more important things. It's been a very, very difficult 7 weeks for absolutely everyone living in this country. I don't think we should be spending far too much time worrying about our money at the moment. But of course, our capital is something that's really important to us. And so I thought this morning's webinar would be a good opportunity to perhaps step back and pause, especially with the current sort of temporary ceasefire in place. Think about our capital, think about our wealth, think about how it's invested, ensuring we're making the right strategic decisions to give us financial security and peace of mind going forward. But of course, like all of you, my thoughts are most of the time elsewhere, hoping that very soon the remaining hostages will come home, that our soldiers will finish their task successfully and be home, that the wounded will make a speedy recovery, and that Israel will be able to return to the life we all enjoyed before the 7th of October. Just checking on the chat, we haven't had any questions. So let's wrap up now, because I wanted to sort of not make this webinar last too long. I wanted to thank all of you for joining, and to say, if you want to be in touch with me about any of the issues we've discussed today, if you want to take the opportunity to spend a few minutes reviewing your financial plans and making sure that you're making the right decisions, then please feel free to email me, andrewa@piawealth.com, or send me a WhatsApp on my number 054 655 9261. We'll be sending a recording of this webinar out hopefully at some point later today or tomorrow, which you can pass on to friends who you think may find it of interest. But for now, on behalf of all of us at Pioneer, keep well and keep safe. And thank you very much for joining us at this morning's webinar. Thank you.